If you've got a globally diversified portfolio, then you will be taking some currency risk. So in this video, we're going to look at what drives currency over the long term, over the short term, and when it's worth hedging that currency risk, but also whether it's possible to trade currency directly. So let's look at currency drivers in a bit more detail. Let's start off looking at the long term, and we'll compare the stock market and the foreign exchange market. What I've done here is compare the US dollar versus 4 other developed market currencies, but also on this graph I've shown the S&P 500, and all of these time series go back to 1971. And as you can see, there's a big qualitative difference between equity, which trends upwards over time and increases geometrically as earnings grow geometrically, whereas all 4 of those currencies hardly move at all when you plot them on the same scale. So immediately you can see that for equity, a simple winning strategy is to buy it, hold it for a long period of time, and almost always, if you don't sell when markets fall, you will make a profit. In order to actually see the currency movements, I've had to change the y-axis of this graph to be logarithmic. And you can see that currency does have long-term fluctuations. You can see that in the lines beneath me, but there doesn't seem to be a strong trending behavior. And as we'll see later, that's because the fundamental drivers of the currency market are different from those of the equity market. But what this also tells you immediately is that if there isn't a long-term trending behavior, a buy and hold strategy in currency probably won't work, the same as it does for equity. Another consequence of that difference in behavior is that for long-term investors, it's not usually worth hedging equity. To show why that's the case, I've shown here the volatility of various assets alongside currency. And this is for the period between 2004 and 2021. So the most risky asset is usually equity. And you can see the S&P 500, this is actually a tracker for the S&P, has a volatility of about 20%. The typical annual move is around 20%, either up or down. In contrast, the volatility of bond funds is usually much lower, particularly short duration government bond funds. So for example, the iShares SHY fund, which invests in 1 to 3 year US treasuries, which are very safe, only has a volatility of about 1%. And even the intermediate duration US Treasury Fund, IEF, has a volatility of under 7%. So if your domestic currency isn't dollars and you buy either of those low volatility funds, then your risk will be swamped by the currency risk. For example, as a sterling investor, the volatility of sterling versus the dollar is about 10%. And that's much more than SHY, which is only 1%. So this is why it might make sense to hedge bond funds if you are going to be investing in them because of their low volatility. Because if you don't hedge, you'll end up just being swamped with this currency risk. In fact, that'll be the primary driver of both the correlation of your bond fund and its volatility. If you buy a very long duration government bond fund like TLT, well there it's not so clear because the volatility of that is greater than that of currency. But this is why you don't usually see equity ETFs offering a currency hedge, whereas bond ETFs often do. So to summarize, long-term investors probably don't have to hedge equity funds. But if you've got a foreign bond fund, then it might be worth getting a currency hedged version of the fund. This question was inspired by a question on Slack from a member of our Patreon community. If you want to ask your own questions anytime you like, then you can do that by joining us. And it's very easy to find out more by clicking on the link beside me and in the description below me. We hope to see you there soon. So now let's look at one of the long-term drivers of currency. And this is called purchasing power parity. And the idea behind this is actually very simple, and a good way to explain it is with Big Macs. And the reason for that is that they're available in almost every country in the world. So let's say you can buy a Big Mac for $6 in the United States, whereas if you buy it in China, it costs 22 yuan. Well, it might be reasonable to expect that the burger buying power of currency should be the same in both countries, in which case an exchange rate that would make sense would be $1 is equal to just under 4 yuan. Because if that was the exchange rate, both of those amounts would give you one burger. If I look up the actual exchange rate for the dollar versus the yuan, it's currently around 6.5. And that suggests that the yuan is undervalued relative to the dollar. if Big Mac purchasing power was the driver of currency. Now, of course, it makes no sense to compare currencies based on the purchasing power of burgers, so in fact we have to compare thousands of different things which people buy. Unfortunately, the OECD does this for us and publishes the data. And they explain that PPP is a rate of currency conversion that equalizes purchasing power of different currencies. The manual showing how the OECD calculates that is hundreds of pages long, but it's essentially a hierarchical process. At the most granular level, the OECD collects data on prices for thousands of products. Then it aggregates them upwards into categories. For example, food would be the category for burgers, but there'd also be categories for clothes, energy, accommodation. Then at the top level, it'll aggregate all of that information into a single number for the price index for that country. Now, when they list the recommended uses for these PPP indices, they say that if you're comparing GDP between countries, PPP is a useful way of making sure that you're comparing like with like. So, for example, if someone in China earns less than someone in the US, that's not necessarily a problem if their purchasing power is higher with that amount of yuan. So if you're comparing GDP between countries, it makes sense to use PPP. And they actually warn against using PPP to look at whether currencies are overvalued or undervalued. However, because we haven't got a great alternative, we're going to go ahead and use that comparison anyway. This is a graph of the strength of sterling versus the US dollar, and the red line beside me is the PPP estimate for where sterling should be based on purchasing power parity. And you can see that during the 1970s, most of the time sterling was very strongly undervalued. That's probably because the UK was particularly weak at this time economically compared to the US. But then by the 1980s, sterling was much closer to its PPP estimate, at least initially. But notice that there are huge deviations away from PPP for long periods of time. For example, in the mid-80s, you can see that sterling versus the dollar almost approached parity, $1 per pound. And that's despite the fact that PPP was showing that sterling was hugely undervalued at the time. You can also see this sell-off in sterling versus the dollar during the period just after the Brexit referendum. Since then, sterling has strengthened and it's now much closer to PPP. But I hope you can also see that PPP is a very poor guide to where currencies should be. The deviations last a long time, and really it just gives you a very crude idea of where the currency should be over the long term. And it's certainly not the case that you could trade profitably based on PPP estimates for currencies. And if we look at the Aussie dollar versus the US dollar, you can see there's a similar relationship between PPP and the actual exchange rate, with huge deviations both above and below the PPP estimate. And the same goes for the Japanese yen versus the dollar. And one politically charged currency pair is the US dollar versus the Chinese yuan. What you can see here is that the yuan is undervalued, so you get lots of yuan per dollar, more than you'd expect with a purchasing power parity model. And that's been true since the early 1980s. Now, what some US politicians claim is that China's deliberately weakening their currency so Chinese exports look more attractive than US exports. How could China do that? Well, it has over $3 trillion in currency reserves in US dollars. So if the Chinese government wants to weaken the yuan, it'll just sell yuan in return for US dollars. What China claims is that it's keeping its currency in line with a basket of its trading partners, of which the US is just one member. But it's certainly true that on a PPP basis, the yuan does look relatively cheap. Another important driver of currency is interest rates. So these models are called interest rate parity models. And again, the intuition here is very simple. Let's consider two countries where one has a very low interest rate, I've shown it in blue, and the other country has a high interest rate, and I've shown that in red. If that's the case, then the people in the low interest rate country probably want to move their money into the other country because then they can earn a higher interest rate. In order to do that, they're going to have to convert their domestic currency. So they'd sell that currency and they'd buy the currency with a higher interest rate. And this naturally weakens currencies which have a low interest rate because they're sold, and it strengthens currencies with a high interest rate because they're bought. To give an example of that, let's look at the US and Japan. Now, around the year 2000, Japan had a relatively low interest rate of 1.7%, whereas interest rates in the US were 3 times that. So the natural thing for Japanese investors to do was to sell the yen, buy US dollars, and then deposit those dollars at a higher interest rate. And the net effect of that behavior was to weaken the yen and strengthen the dollar. In 2021, interest rates are now very different. Much of the developed world now has interest rates which are like Japan. So the interest rate differential between the US and Japan is now much smaller. So while the trade still makes sense, it'll probably happen to a much smaller degree. So the magnitude of the effect on the yen versus the dollar will be much weaker than it was in 2000. In this bottom panel, you can see the difference between US rates and Japanese rates. And you can see that that difference has been falling as US rates converge on low Japanese interest rates. And that trend's been going for about 20 years. And while that's been happening, generally the dollar's been getting weaker versus the yen. Although of course there have been huge fluctuations around the trend. Now there are lots of other fundamental models which try to predict where currencies should be. Some use things like the price of oil, some use trade flows, but none of them is particularly accurate. At best they can just give you a general guide of where the long-term trend is heading for currencies. Now let's think about short-term drivers, and this is dominated by news flow and risk appetite. If we look at what happened to currencies after the pandemic started to affect markets, this is how the dollar moved relative to multiple other currencies from the time just before the crisis hit to the worst point when equities sold off the most. And these are huge currency moves. This is a very unusual period. And generally when people are scared, they go for certain safe currencies. Those are the currencies you can see at the bottom of this graph. So that would include the Japanese yen, the Swiss franc, and the euro. Whereas the currencies at the top of the graph are called risky currencies because these are the ones which sell off when people have a lower risk appetite. You can see that many of these are emerging market currencies like the Mexican peso, the Russian ruble, but also some commodity currencies. And these are countries which generate a lot of their revenue by selling commodities. So for example, Norway's income depends largely on oil. And when oil prices fell sharply, Norway's currency was also affected. And it's probably also worth noting that sterling was one of the currencies that sold off a lot. So it's certainly no longer seen as a safe haven currency. So sterling sold off more than some emerging market currencies like the Malaysian ringgit and the Turkish lira. And then when risk appetite improved and equity markets rallied, you can see that many of those currencies that sold off a lot then recovered. However, some currencies were still badly affected. So for example, Argentina is still in the midst of a very bad economic crisis, and Turkey also has problems with very high inflation. But the key thing about these short-term drivers of currency movements is that they're unpredictable. No one could have seen the pandemic coming, and these short-term fluctuations could wipe you out if you have a very levered currency position. I've shown here the fluctuations of sterling versus the US dollar over the course of one day. And these intraday movements are as close to noise as you can get. They're statistically unpredictable. So if you try and trade on the basis of intraday movements in currency, effectively you're betting on the flip of a coin. That's gambling, not investing. And yet that doesn't stop many people trying to make millions in the foreign exchange market. And there was a great documentary recently on the BBC called InstaTraders, which looked at the Instagram foreign exchange craze, where people on Instagram see advertisements for courses which try to teach them to trade FX. And usually these will be trying to trade those very short-term movements, which are essentially random. And it's not altogether surprising that the documentary found that many of these Forex education companies effectively are multi-level marketing programs. You almost certainly won't make money with the foreign exchange trading, and you'll have to pay lots for the courses, but you can make money trying to sell the courses to other people. Now, when I worked as a cross-asset strategist at an investment bank, I always used to feel sorry for the foreign exchange strategists because their job was almost impossible. What they'd have to do was come up with a plausible narrative about how upcoming news flow would drive foreign exchange, and a lot of the time they'd be wrong. Now, if they can't do it, I'm almost certain that the average person can't do it because we don't have such good resources and we don't have the time to make the forecasts. So I think you're very unlikely to make money with short-term Forex trading. And the standing joke was that to become a millionaire in Forex trading, first start off by investing $1 billion. So I think you're very unlikely to be successful trading short term in the Forex market. And that's because it doesn't have a trend. It's mostly noise. You could just be betting on the flip of a coin. But with equity, at least, you can think more long term and simply ride up that geometric growth by buying and holding for a long period of time. That's much more likely to be successful for most people. And if you do want to not miss any of our future content, just subscribe to our channel. And that way you're helping us and hopefully we'll be helping you. And as always, thank you for listening.